Welcome to the Mortgage Rate Weekly Market Update for the week of July 3rd, 2017. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Well, last week was not kind to mortgage rates. Mortgage rates have moved in higher for the last couple weeks. Take a look at the bond chart on the screen. You can see mortgage bonds were in a tight trading pattern, but they've broken below that last week to set a downward trend. So mortgage bonds sold off, broke below that. So the new trend there is for mortgage bonds to continue to sell off. So with that in mind, with bonds selling off, moving interest rates higher, moving away from the highs of the year and the lowest rates of the year, we're going to recommend locking your mortgage rate to start the week. Go ahead and lock it in. Mortgage bonds could probably sell off. It looks like the stock market is going to rally. If it continues to rally and set record highs, that's going to pull money out of the bond market, and that's going to move interest rates higher. So go ahead, if you're closing in the next month or two, lock in your interest rate, take advantage of the low rates we have right now. Now, if you dig into the economic news, big report last week was the gross domestic product, or the GDP. We got the final reading of the first quarter. It came in at 1.4%. That's very improved over the first reading we got for the GDP of the first quarter, which was 0.7%. The highest driver of economic activity is consumer spending, and consumer spending rose 1.1%, which was up from 0.6% during the first reading of the first quarter. So GDP there better than it was, still not good. At 1.4% GDP is not enough to drive economic activity. So for the long term, we need that to be above 2%, closer to 3% to have a healthy economy. Then we saw on Friday the release of the Fed's favorite measure of inflation, called the Personal Consumption Expenditures, or the PCE for short. Inflation has been coming in very tame since the beginning of the year, so that showed a drop of 1.7 to 1.4%. That's well below the Fed's target of 2%. Now, inflation has been trending down. It was 2.1% just a couple months ago. Now, the biggest driver of dropping the PCE is prices of oil is now being compared year over year to last year, and the price of oil was much higher last year than it is now, so that's making inflation numbers drop. Then we saw weekly initial jobless claims come out on Thursday. They were at 244,000 claims for the week. Very good number. The previous week's jobless claims was 242,000. That'll be the sample week used in the May 2017 jobs report, which we're going to get this Friday. So that shows a strong labor market, so we should look for a good jobs report on Friday. That could be bad news for mortgage bonds and help the stock market rally. So we're going to continue locking into the jobs report. Now, in housing news, we saw some good news there. The Case-Shiller Home Price Index for April 2017 showed a 5.7% gain over April 2016. Home prices continue to rise in part due to a limited supply of homes for sale across the country. We've got low inventory. The low mortgage rates are also driving consumers to take advantage of those mortgage rates, so they're out looking for homes. We have a shortage of homes for sales that's driving the prices upward. Then we saw new home sales for May 2017 jump 3% from April to 610,000 units on an annualized basis. That's above expectations of 599,000 units. Now, new home sales were up almost 9% year over year, so that's a giant jump. The median home price for a new home hit a record of $345,800 as tight inventory pushes home prices up. So it's a great time for home builders, as this low inventory is driving people to new home sales and pushing those prices up. The national supply of homes for sale is at 4.6 months. A healthy home supply inventory is 6 months or more. So we're definitely fighting that, which is causing people not to be able to get the homes they want because they're getting in bidding wars. Now, we saw existing home sales for May 2017 rose 1.1% from April to 5.62 million units on an annualized basis. That was above expectations of 5.52 million units. That was a good sign there of existing home sales. They're up 2.7% from May of last year. The low inventory of resale homes continues to be a problem, and we see that in the next report, which is pending home sales for May 2017. We're down 0.8% from April to 108.5 million units. Now, pending home sales measures the number of homes that went under contract for sale. So that's a future measure of home sales. So with that being down, we could see home sales numbers starting to drop. And again, low inventory, buyers, low inventory. We're not going to get as many contracts, but it is going to drive the price of the homes up. Now in Delaware, some big news there. The Delaware legislative passed the budget bill, and in that bill, over the holiday weekend, they snuck through a 4% transfer tax. So basically, Delaware transfer tax currently is 3%. August 1st, it is going up to 4%. And even bigger news, they are doing away with the first-time homebuyer transfer tax exemption. So this is big news. It's going to have a big impact on Delaware home sales. So quick example, if you're a first-time homebuyer buying a $250,000 house and you get under contract after August 1st, your transfer tax is going to go from $1,875 to $5,000 because of this bill that passed to balance the budget. That's huge. So if you're looking to buy or sell a home, you need to get under contract before August 1st because that's when the bill takes effect. So get out there, get under contract. Don't haggle over a couple $1,000 because you can see you're going to lose it in the transfer tax when that comes through. Also in the local news, the next first-time homebuyer seminar is Saturday, July 22nd in Newark, Delaware at the Christiana Hilton Hotel from 10 a.m. to noon. You can register for that event by giving us a call in the office at 302-703-0727 or online www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.